answer it anytime. Okay, so what we're going to cover here for the next 90 minutes or so, unless you guys get sick of it, you're like, okay, my brain's fried. We're going to cover stuff for the insurance course, for studying for the insurance course. So I'm going to cover a little bit of how you want to study to pass the exam. And I think that's important. That helps a lot. Helps you know what to study, what you need to know, because every state exam is different. So you don't want to get hung up studying something that you don't even need to know. Okay. Or maybe it's like 1% of the test. And if you don't know it, like, not a big deal. So the first step is going online. Like, once you finish the whole course, the steps, or while you're going through the course, I guess you can have it open, but you want to go online and search for the exam outline that's specific to your state. Okay. So for everybody here right now, I'd like you to put your state in the chat, and I can help find the outline for you. And I'll show you how we do that. So, okay, so we got, okay, Maryland, Arizona. I don't know which questions you mean. I'm sorry, Wilma May. The last ones, I don't know where they are, to be honest. Maryland. Okay, so all you search for is your state and then life insurance pre-license exam outline. And then it happens to be run by Prometric. So we're going to go and search for it here. And then life producer is the one you're going to take. Either the life agent or life producer. Okay, so if you're in Maryland, here it is. So Maryland, I'm going to put the link in there. Please save it. I don't want to have to get a text later on being like, hey, I didn't save that link. Can you send it? And then the next one is Arizona. And then the next one is Oregon life insurance pre-license exam content outline. Oregon's one of the only ones I haven't looked at a lot because they're such a pain in the butt to get approved with. They use PSI. PSI kind of sucks, but it's all right. So to do examination, online testing. Examination content outlines. Okay, page 14. Okay. So you're just going to want to look at this laws and regulations examination. And so that's probably part of it. And then producer's examination. So there's 50 questions on the laws, and then there's a producer examination. So you're going to want to know all those topics essentially down until you get to the producer's examination for health. So it's a lot. All this, and this, and then this. So essentially 14, 15, 16, 17, and part of 18. So this is Oregon. I'd like you to, I'm going to put Oregon in there. That one's Oregon. I'll put Arizona in as well. And then we have Louisiana. You got PSI too. Fun. PSI is just weird for us to help tracking it down. It's okay. So I'm going to put Louisiana and then Jacksonville. Florida. Okay. So here's Florida. Okay. So I want you guys to save your exam outlines. All right. Everybody got that saved? All right. So now what I'm going to do, I'm going to show you what you want to do as you're going through the exam. So you want to have this out. I would print it or put it on a separate piece of paper or something. And you want to make sure that when you go through the chapter on the types of policies, you know what ordinary whole life is. You know what limited pay and single premium life are. Universal life, variable whole life. So you want to go and make sure that essentially, and I'm building flashcards out for every single one of these terms, but essentially, and they'll cost money, but at some point you want to go through it and make your own, I'd say, right? So I'm going to have them in course that I'm building out. It'll be like $10 or something because it costs me a lot to have a platform to actually have the slides on, the flashcards on, but it'll be super cheap. But essentially you want to be able to go through and make your own flashcards where you know what the entire contract is, the insuring clause, free look, in every single one of these. So this is where you can study for the exam, like, so that you know exactly what's on the exam. Does that make sense? Okay. You can even use ChatGPT. All right. So if I have ChatGPT is really good. It's $20 a month, but there is a free one. So you just go to ChatGPT, and I'll just do an example here for Florida. I know it says Illinois. I don't know why it says Illinois, but it's not Illinois. So I'll just, just put like this, just copy this information and say, I am studying something like this, studying for an insurance pre-license exam. Please help me create definitions for each of the vocabulary words I give you. Whatever, I don't know that it's, I'll just put that there. It's gonna say, okay, I got you. And it's just gonna start ripping out the definitions, okay? So that's something that can help you understand them a little better. You can go through your course and make your own, but you want to be able to go through and say the definition of each of these so that you know what they are, okay? And there's, like, for instance, the retirement and other insurance concepts, like the qualified, non-qualified plans for Florida, it's only 9%. So those ones can get kind of complicated, but obviously 9% of your attention should go there, right? So Florida is very heavy on the laws. They have 24% for general laws and then 18% for the statutes related to insurance. So 42% of the Florida exam is related to the laws. If we go to this one here, I think this was Arizona or Maryland. Yeah, I forget which one it is exactly, but whatever. You go through and the same thing, like what's the purpose of licensing, provisions and definitions, and you want to go through those state specific sections and understand those different features in the licensing and regulation. And then there's general concept, risk, exposure, hazard, peril, loss, avoidance. So you want to go through your course and make sure that you're defining these things. All right. So I would make a Google Doc or a Word doc or write it out or whatever, or some sort of, maybe a PowerPoint presentation so that you can go through, have one slide or Google Slides, right? One slide be the word, the next slide be the definition and what you need to know about it. That's like what I'm doing for the slides and building out. So a student can go through and look at them just like that. Okay. Any questions about that with the outlines or anything?
No, that was helpful though, so we know what to study for.
Yeah, because every state's a little different. And then like you're going to see PSI. Some states use Prometric. So if anybody ends up being in a state that uses the Prometric, it's going to have a different outline than Pearson VUE, and then PSI, they have different outlines. So like the courses usually have questions. It's like a hybrid of each, right? They'll have like all the questions from all of it. That way you know it all. But they're not going to have a question that's not on that outline. Pretty much, they're not going to like throw something random in there. Okay, they might to try to test material for another exam, but it won't be counted. Some states will do that. Okay, you also want to just treat this like a big vocabulary test. All right, big vocabulary exam, because that's all it is. It's a big vocab test. Sometimes the insurance plans and programs are good, easily depicted as pictures. If you can get little pieces of like figurines or something to use to make a pictorial like situation of something, it'll really help. So for instance, an annuity, a deferred annuity. Have you guys been studying that, reading about annuities? So if you have the person before the annuity is paid, and you take what the person's like one piece of one rock, and then you take little pebbles and you move them into the pile for the accumulation phase, and then you move the person over to the annuity phase or the annuitization period or whatever it's called, and then you start kicking out little pebbles back to that person. And there's actually more pebbles. They grow because they grow interest. So anything you can do to graphically or visually depict it for yourself, that's when you know that you know it. Okay. So if you can create something like that, that's when you really know that you know it. Also, use I have a YouTube channel that covers a lot of the material. There's videos on it. So I'll put the link to that in the chat here. YouTube.com/. Okay, so the link's in the chat there. You can save that. And I have like 70 something videos that cover a lot of the parts of the exam that may be a little bit like more complicated to understand just from reading a paragraph. The courses are tough sometimes, I think, because it's in paragraph forms, trying to explain something that has to be broken down. So it's like, I don't know. I know when I was reading it, I got kind of frustrated because I'm like, man, this is just like paragraphs and paragraphs and paragraphs, and I want to see something. And you can also utilize ChatGPT to be like, hey, I don't understand an annuity, right? Can you explain to me how an annuity works so that a first grader could understand it, right? Or something like that, like to have it break it down super simple and then it may be in, better terms. So like, for instance, if we do that in ChatGPT here, let's see what it says. So we'll say, can you break down how an annuity works so that a first grader could understand? Imagine you have a piggy bank and every week you put some of your allowance into it. One day you decide you want to save your money in a special way so that you can get a little bit of money every week when you grow up. It's like a big magical piggy bank that you give your money to. This magical piggy bank promises to keep your money safe and give you a little bit of money every week or month when you're older, kind of like getting an allowance from your parents. So like, so you can use that tool sometimes to explain things that are complicated in a more simple way. Okay. You can also use this to quiz yourself. So I can say, please create 10 multiple choice questions on deferred annuities, like those like questions that may be found on a standardized exam administered by Prometric. Let's just say Prometric, if you're using Prometric, one of them. So what is a deferred annuity? Which of the following is a key feature? What's the accumulation phase? And then after it makes these questions for you, you can try to guess them. Yeah. ChatGPT, it's AI, it's artificial intelligence. So, and then it gives you the answers here. So you can have a little quiz for yourself to try to understand it a little better. All right. So if there's concepts you don't understand, utilize these tools to help you understand them better and watch my YouTube channel to see if there's anything that can help you out. Any questions about any of that stuff? Okay. So what I want to do, I want to kind of leave this up to you guys, what you think would be better to study, because I don't want to cover something that you feel like or you're comfortable with, and some things, some of you may be comfortable with, some of you may not be comfortable with. So I'm going to give topics. I'm going to go like just list some topics out here and put in the chat which ones you think are best. So types of life insurance policies and their features, whole life, term life, annuities, stuff like that. Riders, provisions and options. So the different type of riders, different beneficiary designations, all that stuff. So we can go through this. These two are obviously big pieces on every state's exam. And this as well, the completing the application and underwriting. And retirement and other insurance concepts. All right, so put in the chat there if you're going to cover some of these, what would you prefer? Okay, Caleb put underwriting. Okay, so Caleb was there first, so I'll go over underwriting. So I'm going to just go through here and cover some of these topics. Most of these will be on most of you guys' exams. We'll see if there's something here that has policy loans, no forfeiture, life insurance policy provision options, term insurance, basics, contracts, insurers. Yeah, so they'll be on here because it's all like different. Where do they have it? Okay. Beneficiaries. Okay, policy they have it kind of under here. Whereas, okay, well, this one we'll look at. Let's see. Triple interest. So yeah, so this one's scattered all out it. So this has it just in a way where all these topics here will be on an exam. These are like basics on the underwriting ones. So required signatures on an application for insurance, you have to have the signature of the agent. Okay. So the agent has to sign, and the person being insured has to sign as well. So the proposed insured. And also, if someone else is going to own the policy or pay for it, typically that person has to sign as well, because they have to sign like, I'm owning this, I'm the owner, or you can draft my bank account for this policy. Does that make sense? Beneficiaries do not need to sign a policy. Okay, so the beneficiary does not have to sign a policy. Changes in the application. So if there's any changes in the application, they have to be initialed. Okay. Some companies require the agent to initial it. Some companies require both the agent and the client, but at least the client has to initial it. So depending on the state, they'll have that. I think your course, do you guys remember if your course says if it's the client or the agent and the client? Pretty sure the client has to initial any change on there. That's like standard on there. So a change in app. Go ahead, Victoria. We're going to say something. Okay. Yeah. So any change in the application has to be initialed. So if there's like you go through and you send it, usually what happens is you'll go through and then you'll submit it to the insurance company and they'll say there's an issue here and you have to go back and have it changed. We don't do that. We do them all over on the internet here. So this is like, if someone was face-to-face selling insurance, but we don't do face-to-face. So it's pretty easy to check your work and make sure everything's here, because there's just fields you have to fill in and it's all done right there. And if there are any things that need to be changed, we call in and they'll do it over the phone. So a consequence of an incomplete application: if an insurance company issues a policy and the application was incomplete, the insurance company cannot hold the insured liable for any information that was not included. Okay, so it's like, if you don't fill out a part and then the insurance company can't say, you don't answer a health question, and then the insurance company approves the policy, and then you die from that question you didn't answer, they can't be like, well, you died from that and it was on the application that you didn't answer it. So they didn't take that into account at all. Does that make sense? So yeah. So if there's an incomplete application, it rules it. That's what it is. That's the whole application. Which gets into entire contract, which is a legal concept. You're going to read that entire contract. The entire contract provision states that the entire insurance policy is the application, plus any amendments and endorsements and any applicable changes that need to be on there in the policy. Everything included in the policy. What the entire contract means is that they can't use outside information once it's issued they can't bring in outside stuff to influence whether a claim is going to be paid or something like that. So it's like, once the contract's there, it's like the policy, the application, and any riders or endorsements. That's the entire contract. They can't later be like, oh, well, this happened over here. Oh, we forgot to mention this. So that's gonna. So like if a company, doesn't include, so for instance, say someone's like a skydiver. If they don't include something that says, oh, if you die in a skydiving accident, we're not going to cover it. If they don't include that, then they have to pay it if the person dies in a skydiving accident. Does that make sense? They can't go back and be like, well, that was a hazard, so, hazardous activity. Okay, warranties and representations. This is kind of confusing in life insurance. A warranty is something that's guaranteed to be true, and a representation is something that someone believes to be true to the best of their knowledge and belief. So a warranty is like, I am Justin Von Eigen. And if that's not true, then the contract is completely void, right? So that's like almost fraud. Like if I was like, no, I'm Victoria Dale, and then they issued me a policy, like I'm not, you know what I'm saying? So that's like something that's guaranteed to be true. I am the person applying for insurance. I'm not Justin to the best of my knowledge and belief. I am Justin, right? A representation, an example is a health question, like on our applications. Have you had a heart attack in the last 2 years? To the best of my knowledge and belief, I have not had a heart attack. Okay. Because think of that, like someone may not know if they had a heart attack. They could have. think they may call heart attacks like myocardial infarctions or something like that as well. I mean, I think that's like the fancy name or something. Whatever the fancy name for a heart attack is, if the doctor says that they had that and they didn't know it was a heart attack, then they're like, oh no, I'm good. I had a client one time who had 47 heart attacks in 2 years. And he didn't know it was like a workers' comp claim. He got electrocuted on a roof, and the doctor kept telling him that nothing happened to him because workers' comp was paying the doctor not to say anything. And the guy had almost 50 heart attacks in 2 years because his heart wasn't firing right from the electricity. And he went to another doctor, and yeah, he sued him for like millions of dollars and stuff. But so to the best of his knowledge and belief, no heart attacks, nothing. So that's a representation. You guys see the difference? We're going to get some clients who age is a representation too. Some of our clients literally don't know how old they are. It's funny. They're like, I'm 72. And then I look at the date of birth. I'm like, you're 73. They're like, well, we just celebrated my 72nd birthday. I'm like, okay, your whole family can't do math, right? It's kind of funny. So that's the difference between a representation and a warranty. A warranty can completely void the contract. A representation is something that you don't want to be a misrepresentation. Though. A misrepresentation is when you lie, right? But it's like a representation is like material misrepresentation. But they think, hey, I think I'm good. That's it. And what some of our clients you're going to see, like we work with seniors, and like some of them are maybe have memory issues or something going on where they don't know. They'll be like, oh yeah, I'm totally fine. And then we run the prescription history check and like, it's like, a laundry list of medications. Okay, so collecting the initial premium and issuing the receipt. So when you sell a policy, it's ideal to get an initial premium. So it's ideal to get a policy. Make sure no one's in the waiting room. Okay. The ideal situation is that you collect the premium with the application. What happens when you collect the premium with the application, which is the money that they're paying for their policy, you collect the first premium when you do the application, it essentially kind of binds coverage, and it says, hey, if that person paid today when the application was submitted, all right, that's the consideration. Consideration is their money in the statements on the application saying, hey, this is what I want you to consider to accept my offer for insurance. Does that make sense? So the insured, the person applying says, I want you to consider my offer and acceptance, consider my offer with these things I'm giving you, my statements on the application, and the money. When they have those two things, you're issued a conditional receipt. That says, okay, if your policy gets issued, it will be effective from the day you completed the application and submitted your first payment. Which means that if the client submits the application and pays and dies the next day, if they end up getting approved for the policy and the death was actually something that they didn't have any previous issues with or from, and they get approved for it, it'll pay out. Does that make sense? I had a lady one time who got a policy. It was a $30,000 policy, and she wanted to wait a month to pay because she had to go to Chicago to get her bank account fixed or something. And I was like, yeah, no problem. Well, a lot of our clients push their first payments out, so it wasn't anything abnormal. And I called her a few weeks later to follow up, and her son answered, and she had died without making the payment. And he said it was sudden. Who knows? Maybe she had something that the doctor would have, that when they reviewed the medical records, they would have denied the claim anyway. Because if you die in the first 2 years, there's something called a contestability period, where the life insurance company can contest the claim. So that's why it's important to collect the premium right there with the application. Also, typically insurance companies, the way that they pay their commissions, you get more upfront, or sometimes you don't get paid until the client pays. Right. So that's how collecting the initial premium and issuing the receipt work. Some of them call them binding receipts. Some of them called conditional receipts. You have to look in your course to see exactly what the differences between those. And here it just says issue receipt, so it's probably a conditional receipt. Replacement. There are a lot of state laws regarding replacement, so this will also be covered in depth in the state law sections that you read. Replacement is essentially when someone cancels or uses money from an existing policy to get a new one. Okay. So if they cancel one policy and then get a policy with you, that's a replacement. If they take cash value from one policy to get another policy, that's considered a form of replacement. And it's important that people have to sign disclosures acknowledging that there's a replacement, because it can be not in the person's interest. Like, think about this. And it's very important as an agent that we don't do unethical replacements. Because imagine some guy has a big whole life policy that he's had since imagine he's 80 years old. He's had a policy since he was 30, and there's a ton of money in cash value. And that agent says, "Oh, let's take all this cash value and buy a new life insurance policy." There's no way the guy's going to get a bigger death benefit for the amount of money that's in there, right? Because he bought that policy when he was 30. So that's unethical, because the guy's going to have less life insurance in that situation. And there's a contestability period started. So if he dies in the first 2 years, the policy may not pay out. So you have to make sure that replacements are ethical. It's in the best interest of the client. If a client just got a policy yesterday and you can get them one that's $20 a month cheaper, that's an ethical replacement, right? It's like, okay, yeah, they're saving money. Typically, if it's over 2 years that the policy's been in force, a replacement is not recommended, because then they're outside of the contestability period. And if they die, the company's going to pay no matter what. They're not going to check medical records or anything. Disclosures at point of sale. So HIPAA, it's like the Health Insurance Portability Act or something like that. It just says they can't give your private information out. If you give them your health info, they can't share it with anybody else without your permission. Okay. And then HIV consent, people have to consent to agree. They have to agree to be tested for HIV. So they can't just like be like, "Oh, we're going to take your blood and test you for HIV," and not tell you we're testing you for HIV. Okay. And HIV tests cannot be administered based on sexual orientation. So, yeah. U.S. Patriot Act and anti-money laundering. So the Patriot Act had to do with anti-money laundering. It was essentially the government's way to claw into our everyday business and figure out where we spend all our money. Very sneaky. But they want to make sure that people aren't laundering money for terrorism through life insurance. So what we sell, our policies, it's literally impossible to launder money. But what the US Patriot Act says, it's like, just be on the lookout for people doing sketchy stuff. So if someone's like, "Oh, I have $100,000 I want to put into an annuity," and then cancel it, and then they cancel it the next day, and they don't care about paying the fee to cancel it, that's sketchy, right? It's like, okay, you just lost like $30,000 overnight. You don't care. So wash the money. So people can use financial products to launder money and turn it into clean money, so that it comes from a legitimate source. So we work with fixed income seniors, so like that ain't going to happen. And then our policies will never have more cash value than the person puts in. And it takes 2 years to accumulate any cash value. The cash value is usually really small with these policies. So you'll never run into people doing that here. It's very rare to run into it anywhere. To be honest, I've never even heard of it, but they make you do that because I guess people do sketchy stuff sometimes with insurance. Gramm-Leach-Bailey Act. I forget what that was. I think, here, let me ask ChatGPT. What was the GLBA Act for insurance privacy? Has something to do with that people's information is protected, I think. Yeah, so it protects consumers' personal financial information. Yeah, so it's just a rule saying they can't give your personal financial information out to someone else. Okay. Any questions so far about any of that stuff I covered in section 3A? Okay. Next, we're going to go over underwriting. So insurable interest. Insurable interest means that the person who owns the policy is going to have some sort of, and the benefit, the person who owns the policy is going to have some sort of like financial loss. Okay, and they look at insurable interest for the beneficiary as well. So the person benefiting from the death of someone has to actually have a loss in their death. Okay, so like obviously if you get a life insurance policy on yourself, there's inherent loss there because you're dying. But like I can't go take a life insurance policy out on Elon Musk just so that I can, benefit when he dies. Like can get a massive policy. So there has to be insurable interest. So there's inherent insurable interest in parents with their kids and vice versa, kids with their parents, spouses. So those are the common, most our business partners, right? If someone's in a business, say Kayla and I started a business, and we want to make sure that when, oh, hold on, might be someone in the waiting room here. No. So say Kayla and I started a business, and Kayla wanted to make sure that if I was married, my wife wouldn't, like, if I die, she wouldn't take over the business because she'd have no idea what she's doing, right? So say the business is worth $5 million, I'd get a policy on me or on her to say, hey, for 2.5 million, I'd say, hey, Kayla, if you die, I'm gonna buy your portion out from your family because your family will have no idea what they're doing with our business, and vice versa, her to me. Okay. So we can buy the piece out. Also, there's key person insurance, which is insurable interest. So say I work for Kayla and I'm her CFO, Chief Financial Officer. If I die and we have a huge company, it's going to cost her money to find a replacement for me, and it's going to cost her money for any lost revenue that from when my job doesn't get completed. So she can get a policy on me that estimates how much money she'll lose hiring and training a new CFO, and from me not being able to do my, or for my job not being done until she hires and gets someone new trained. Does that make sense? Also, like a creditor, like a bank can have insurable interest in someone if they get a loan out through that bank. So sometimes when people get very big loans, they need to get life insurance to cover that loan to help satisfy a loan requirement. Okay. Any questions about insurable interest? All right. Medical information and consumer reports. So medical information is obtained from the prospect, the insured, the proposed insured. They check typically the Medical Information Bureau. The Medical Information Bureau is a company that insurance companies report their information to. So they kind of share data. So it's saying like they do it to kind of help each other out. So say Lisa applied at one insurance company and they denied her for whatever. Then that information gets entered into the Medical Information Bureau so that if I went applied somewhere else, they would know like, hey, okay, Lisa got declined, or she went applied somewhere else. They know she got declined for whatever conditions. Does that make sense? So they use it to share medical information. Also, they check prescription history reports as well to check what prescriptions people take, because people only take prescriptions if they're diagnosed with something. Okay. And they also might check attending physician statements. So it's like a statement that a doctor might give. Okay, so they may ask a doctor to write a statement for, you know, about something about the prospect to make sure that the proposed insured is healthy. Consumer reports, they may use consumer reports to check a person's like legal history and if they typically do crazy stuff or something like that. That's usually with bigger face amount policies. I'll check consumer reports on them. They have to be notified too whenever the medical information or consumer reports are accessed. And if there is a negative result that comes from consumer reports, they have to be notified the reporting company that was used to determine that negative result. Fair Credit Reporting Act states that people must be notified of their consumer reports being in their credit reports and consumer reports being checked, and that they have to be notified if there's any adverse information and how they can contact the place to dispute any adverse information in their credit or consumer reports. Risk classification is essentially how insurance companies rate people based on their health conditions or their risk that they pose to them. So typically, like in the courses, they talk about preferred, standard, and substandard risk. Preferred risk is above average health. Standard risk is average risk, and then substandard is below average. I mean, above average risk. So it's much higher risk. Preferred, low risk, standard, average risk, substandard, high risk. Okay. And then stranger or investor owned life insurance, STOLI or IOLI. It's not AOLI for everyone who's hungry. we can look at STOLI or IOLI policies as policies that really don't have insurable interest. Okay, some states, a lot of states don't allow STOLIs or IOLI, investor-owned life insurance anymore. It's kind of like someone's investing off someone else, or making money off someone else's life. It's when someone gets a life insurance policy without any insurable interest. Okay. There's no insurable. It'd be like if I got a policy on Elon Musk. And I have no insurable interest. Okay, so delivering the policy. When coverage begins. Coverage technically begins when the conditional receipt is issued, as long as the policy is issued. That's the effective date. Okay. Now, if a premium is not collected with the application, coverage typically begins when that first payment is made and a statement of good health is obtained. So if the client does not make a first payment with the application, they typically have to sign a statement of good health saying that, yes, I'm healthy. I'm still healthy. Nothing's happened since I did this application. And that's when the coverage will begin. Okay, which would typically be when the policy is delivered. So the policy really begins when it's delivered, but it will be backdated too, right? If the person had made an initial payment with the application. Explaining the policy and its provisions, riders, exclusions, and rates to the client. So essentially, you have to be able to explain it when a policy is delivered. You have to be able to explain the policy features and riders and exclusions and ratings to the client. So you'd say, okay, well, you got approved for the preferred rating. There's an exclusion for backpacking because that's what you do for fun. There's a rider on there to protect you against, to cover a nursing home if you end up in a nursing home. And there's, you're just essentially going through and explaining what the policy is. That's really all that's saying right there. Okay. And when you deliver, that's done when the policy is delivered. Any questions about that stuff I covered so far? Okay. So contract law, elements of a contract. There's different parts to a contract. So the consideration, we went over that. That's what the proposed insured is offering. So it's their premiums plus the statements on the application. Okay. Next is the offer and acceptance. So the primary insured, the proposed insured makes the offer with the consideration and representation on the application. And the insurance company decides whether they accept it or not. Before, I thought that the insurance company was offering insurance to the insured, and the insured would have to accept it, but it's the opposite. The insured says, I'm offering you this, and the insurance company has to accept it for coverage. Competent parties. So competent parties is just, are they of legal age? Are they under the influence of alcohol, drugs? All right. And are they in a mental state that they can actually make a decision? So there's a few features of competent parties, but it's essentially like, is someone with it? And are they old enough to make a decision? Right. Legal purpose, that's just like, you can't for a contract, you can't have a contract on something that's illegal. Right. It's like if it's a contract to kill somebody, obviously, like that's not an okay contract. You know what I mean? So it's like you're saying that the contract has to have a legal purpose. All right. If like life insurance, say someone got a life insurance policy to pay off a debt to a drug dealer, that's not like, okay, So yeah. Unique aspects of the insurance contract. Conditional. So it's conditional. Insurance contract is conditional, meaning that it's based on the condition. The insurance company will pay out upon the condition that the insured dies or whatever else happens to them based on the policy. Maybe they get terminally ill or they're disabled or something like that. Okay, but a condition has to be satisfied in order for the benefit to pay out. Does that make sense? All right. Unilateral. I always get unilateral adhesion and aleatory confused. So define unilateral. I think I know. I'm pretty sure I have the right one. Insurance contracts. Yeah, so yeah, so it's unilateral is that the insurance company is the only one that's bound to do anything. So the insurance company has to pay the claim if the insured dies, but the insured doesn't have to, and as long as they pay their premiums, but the insured does not legally have to continue paying their premiums for life insurance. Does that make sense? So it's pretty one-sided. Only one side has a legal obligation. All right. Contract of adhesion is that there's no negotiation. Like that's what it is. Okay. So contract of adhesion is like what it is what it is, and there's no negotiating to it. Like this is it. Take it or leave it. It's take it or leave it basis. It's not like buying a car. And then aleatory. Aleatory is when one company is when it's one-sided in terms of what they're risking. So like insurance company is gonna pay a huge benefit, and the insured only has to pay a small premium relative to the benefit that they're getting. Does that make sense? All right, cool. Any questions about that? All right. Any question? What do you guys want to cover next? Which section? We got we can cover the policy types or the riders, provisions, options, and exclusions.
Probably the provisions and stuff.
Okay, cool. So waiver of premium. We're going to talk about the riders here, policy riders. Waiver of premium is a rider where the insured So a waiver of premium is where if the insured becomes disabled, the insurance company will pay their premium for them. So that's a rider. You have to pay extra every month so that if you are disabled, the insurance company will continue making your premium payments for you. It costs money. Every insurance company has a different definition of disabled. Usually how it works, in the first couple of years, it's disabled from doing your own job. And then after that, it's are you disabled from doing any job at all? So they usually cover it for a year or two if you can't do your own job. But then they're like, hey, are you completely disabled or can you just not do the job you did? Right. All right. Waiver of monthly deduction has to do with a universal life policy. So in a universal life policy, there's a cost for insurance. Okay. And it will make sure that that cost for insurance gets paid. So it's different between a whole life policy where whole life policy is like, it's the same premium every month, no matter what, right? Universal life, you can increase or decrease your premium. They're flexible. There's a cost for insurance though every month. So there's a base cost that needs to be paid to make sure that the insurance stays in force. The waiver of monthly deduction rider, they say, we're just going to cover the cost of the insurance. You can still put more money in if you want, but they're going to cover the base cost of it. Does that make sense, guys? The difference there? Because in universal life, there's the cost plus whatever else you want to put. They're just going to cover the cost, not the extra. So if you were paying $400 a month and the cost is $250 a month, and you were just putting an extra $150 in there every month for cash value and stuff, they're not going to cover that extra $150. They're just going to cover the cost of $250. Okay. Guaranteed insurability. Guaranteed insurability is where if someone gets, typically it's with a whole life policy, and either in different timeframes or different life events, they can add more coverage. So when someone, maybe when they get married, they can add more coverage, or when they have children, every time they have a child, they can add more coverage, or every 5 years, they can add more coverage, something like that. So it's saying that it's a rider that they pay extra for, saying that, hey, at specific points in time or events, I want to be able to add insurance. They can do that without having to go through underwriting to prove insurability. Okay. Pay or benefit. Pay or benefit means that if a parent is covering a child's insurance policy, that the premium is covered if the parent dies up until a certain age or however long the insurance company says. All right, so if there's a juvenile life insurance policy, parents paying for it, parents die, policy is just going to lapse. It gets paid for however long the insurance company says based on the rider. Okay. Accidental death and or accidental death and dismemberment. Accidental death is that if the insured dies on accident, there's a rider that will increase the death benefit if death is from an accident, the result of an accident, or dismemberment as well. So they can have it where if you lose a limb, you lose eyesight, you go blind, lose your hearing, something like that, where there'll be a money paid out. Any questions about that?
Wouldn't that be good to put on every insurance policy?
Yeah, it would. It would. Some people don't like some. I've been at some companies where they're like, yeah, it's not even worth it because the chances of someone using it are so slim. But I think it's worth it just because it's like so cheap. It's like it's almost not even. It's insignificant typically compared to the cost of the policy. Term riders. A term rider is if you get a whole life policy, you could get term insurance coverage on someone in your family. So say I was married and I got a whole life policy, I could get a term life rider on my, oh no, that's other insured, sorry. So term rider would be if I get a whole life policy for $100,000, I can get a term life rider on top of it for $500,000 to increase my total amount of coverage without having to get two separate policies. So instead of me getting $100,000 whole life and a $500,000 term, I can just get the $100,000 whole life and add the rider on top of it. And the cost is kind of shared between the two policies. So it's one policy with a rider, not two separate policies. So it can impact how cash value grows and stuff too, and how much you can put into the policy as well, because technically it's a higher face amount. And then other insureds. So other insureds is a rider where you can get, like I said, term coverage on your kids or your spouse or something like that onto your policy without having to get separate policies, right? A lot of times too, term riders for other insureds can be guaranteed issue or very, very minimal underwriting. That may not guaranteed, but the underwriting may not be as strict as like a regular policy. Okay, depending on how much coverage you want, that will determine what the underwriting is too. Obviously, if someone wants $1 million term on their spouse, then they got to make sure the person's not going to die tomorrow. But yeah. Long-term care insurance, a long-term care rider is to help cover the cost of long-term care. So nursing homes, stuff like that. So what it does, it may take from the death benefit, it may not take from the death benefit. It's just all it is. It's a rider that says, hey, we're going to pay out a benefit or use proportion of the death benefit to help cover your long-term care costs. All right. Long-term care is like super expensive for insurance. Return of premium. So there's return of premium term and then return of premium whole life. So in a return of premium whole life policy, the death benefit includes the premium paid in. All right. In a return of premium term policy, it typically means if you outlive the policy, you get a portion of your premiums you paid in back if you outlive the term. It's typically the difference between return of premium term versus a return of premium whole life. They both pay the premiums back, but one's if you got to die to get it back, and the other's you outlive the policy, or the other, it's either outlive the policy or you die. The premiums get paid back. All right. Disability rider. So that's waiver of premium kicks in if there's disability typically, but a disability rider says, hey, we'll pay some of the death benefit to you or a benefit if you're ever disabled. Any questions about the difference there between waiver of premium and a disability rider? Waiver of premium means you don't have to make your payment. The disability rider means you're going to get money for being disabled. The cost of living rider. Okay, next one, cost of living rider. All that means is your death benefit will increase to match the consumer pricing index or inflation. Because if you get $1 million policy now, in 20 years, $1 million isn't going to have the same impact. That's how they say it'll adjust for inflation over time. It's a cost of living rider. Okay. Next, entire contract. So the entire contract is everything in the policy and the application and the riders and endorsements. So the entire contract, what's included in the entire contract is the policy, the issued policy, the application, and any riders or endorsements. Nothing else outside of that can be used to influence the contract. Okay. The insuring clause is the insurance company saying that, hey, if you die, we'll pay a claim. It's the insurance company's promise to pay a claim. Free look, we're looking at free look period here. Free look is if a policy gets issued and delivered, typically the proposed insured has anywhere from 10 to 30 days to return the policy for full refund of their premiums. Depends on the state. Every state has a different free look period. Some it's 10 days, some 14 days, some 30 days, some 20 days. But there's a free look period that will says, hey, you got approved. Here's the policy. You get time to look it over. A lot of times they do that too, because someone may not get approved as applied for, right? So if they get approved for the policy, but it's not like they applied for, they can get a refund for the money that they paid. Does that make sense? Any questions about that? Yeah, Victoria. Yep.
I have a question. How does it work that we're all from different states and we're going to be working for you guys who are stationed in Florida, I guess is.
Yeah. So our agency is licensed in many states. So you can only sell insurance in a state you're licensed in. So the agency is licensed in a bunch of states, and we have agents in those states, and we all earn commissions because we're all licensed there. Consideration is, I went over that before, but it's the application and the premiums, the statements in the application and the premiums, saying, please take this into consideration to give me insurance. Okay. Owner's rights. So owner's rights is what someone can do who owns a life insurance policy. So it could be with cash value and cash value. Like the owner has access to the cash value, right? And the owner can change the beneficiaries unless they're irrevocable. The owner can assign ownership to someone else. So owner's rights just means I can do what I want with the policy, pretty much. Does that make sense? They can cancel it, they can change it, give it to someone else, they can change the beneficiary. Remember, insurable interest only needs to exist at the time of the policy, at the time of the application. It doesn't need to exist forever. For instance, husband and wife, say they get married and husband takes out a policy on his wife. If they divorce, some states require that the policy gets canceled anyway, or that something happens. They have to change something in there. All right. So some states have that, but like insurable interest may not exist after that, 10 years after a separation. So it doesn't have to exist through the entire contract. It just has to be at the inception. Beneficiary designations. So there's primary beneficiaries. So a primary is the first person to receive money if the insured dies. All right. The contingent is the person who gets the money if the primary insured is dead. So the contingent gets it next. So primaries first. There can be multiple primary beneficiaries. So say there's 2 primary beneficiaries, they may have them split at 50-50. Okay. They may have them split at 50-50. But if there's a primary beneficiary and a secondary, the secondary is only, or contingent, the contingent's only going to get money if the primary is dead. Okay. Revocable mean an irrevocable. A revocable beneficiary can be changed at any time. Some of our clients like take this to the extreme. Like some clients, they're like, some clients are like, oh yeah, I want to change. Oh, I just got in a fight with my daughter. I'm making my son my beneficiary. And then some are like, oh no, change it back to my daughter. My son's being a jerk now. And they'll like switch it like once a month. It's like insane. An irrevocable beneficiary cannot be changed without permission from the beneficiary. Okay. Okay. A common disaster. Pretty sure the common disaster means that if the insured and the primary beneficiary are in a disaster, it's assumed that the primary beneficiary died first. Okay, so let me just give me the definition of the common disaster clause in life insurance in one sentence. Yeah, so the primary beneficiary must survive the insured by anywhere from 30 to 90 days to receive the death benefit. Okay. So typically what it means is if the primary insured if the primary beneficiary and the insured are in a accident or a common disaster, say a plane crash, the primary beneficiary has to outlive the insured by 30 to 90 or 60 days or whatever, depending on the state, for them to receive the benefit. So like say they get in a plane crash, insured dies right away. Then the primary beneficiary dies 10 days later. Typically, the primary beneficiary's estate will not get any of the money. It'll go to the contingent beneficiary. Does that make sense? So if the insured and the primary beneficiary die around this from the same accident, it's assumed that the primary beneficiary died first, even if they die after, but it has to be within a certain time frame. But it kind of makes sense because they're like, hey, oh, I want like this person to get, I want I have a policy. I want my son to get it. If not, if he passes, I want my wife to get it or something like that. That way it's not like, oh, well, oh, my son's family gets it because he didn't get it, so that way they have it so that the next person in line gets it, because that's really how the beneficiary wants it to be. If he wanted the beneficiary's estate to get it, then he would have put it in their estate or to their family members. Like if it's like, oh, it's going to go to my son for his kids, he should just make his grandkids the beneficiaries. You see what I mean? Yeah, that's why. Minor beneficiaries. So that's a good transition. Minor beneficiaries. A lot of times someone's assigned as a custodian. You can make a minor beneficiary, but usually someone's assigned as a custodian of the account so that the person can't go buy like a new Lambo and they're 17 years old and spend all the money. Okay. So it's usually by like 18. It depends on the state, but usually then they'll have access to it. But they can specify to like, okay, it can only be used for educational purposes up until this age, and then they can do whatever they want. But a minor beneficiary, if it's not assigned in the policy, then like the state looks after it essentially and says, that can only be for certain purposes. Now, if he's a mechanic, maybe he can go buy the Lamborghini. I don't know. Designation by class. I don't even know what that means. I'm not sure what that means there. So I'm thinking class beneficiary, primary, contingent, tertiary. Anybody read about that recently? Designation by class. It's got to be in the course somewhere. I think I've been on a pretty good roll about knowing most of this stuff, but I don't know what that means there. Anybody got an idea?
I don't recall that.
Okay. All right. Well, maybe somewhere on there. Okay. Now, premium payment modes. So premium mode is how frequently it's paid. So monthly, semi-annually, quarterly, annually, stuff like that. Typically, the more frequently a premium is paid, the more money it costs. It's not as big of an impact on life insurance, but car insurance, it's a big one. So next time you pay your car insurance, if you look at the 6-month premium, you save like so much money compared to the monthly. It's wild. So if you can do it, do it. You save a lot. Life insurance, though, it's not as big of a deal because the thing is they have to pay for the payment to be processed every time and has to go through. There's administrative costs, right? They got to keep track of it. They got to process the check. They got to go through, put it through the banking, and yeah. Grace period. Grace period is the time that they have to make a payment after their due date to not have the policy lapse. Okay. So grace period is like, let's say they make a payment or they have their payments due on the first of the month. If they don't make their payment, they typically have 30 to 60 days, depending on the state, to make a payment without their policy lapsing. It's usually like 2 months. They can miss 2 payments and then the third one, it lapses. So that way, if there's a mistake, right, or like the bank account closes or something, then it's not just going to cancel right away. And if the insured dies during the grace period, the benefit is paid out minus the premiums that are due. Any questions about grace period? Okay. Automatic premium loan. So automatic premium loan is a feature where if the client has cash value in their policy, right? If there's cash value in the policy, it will use a portion of that cash value to pay the premium. Okay, so the grace period in that case wouldn't matter. Instead of the policy lapsing after the grace period is over, it just pulls the premium out of the cash value in the form of a loan against the cash value. So it pays for itself essentially. Now, sometimes it's really cool. If you have a policy that gets dividends, you guys remember learning about dividends? If you have a policy that receives dividends from a participating company, the dividend sometimes can accumulate so much where it's earning so much interest that it can continuously just take a premium loan out from itself or use those dividends to just pay it back, pay the premium. And then it's called premium offset, where the dividends offset the premium and you're earning more than it costs and you have to stop paying. You can stop paying. They'll structure some premiums based on what they think the projected, what they think the projected dividends will be to do that. Okay, level or flexible premium. So level premiums mean it's just the same all the time. Flexible means flexible. You can pay less or pay more. Okay. Reinstatement is if a policy lapses, right? You don't make a payment, goes outside the grace period, you miss it, it lapses. Reinstatement is when you restart the policy. So to get it reinstated, you have to pay any back due premiums and submit a statement of good health and potentially go through underwriting again. Probably go through underwriting again, where they just check your health to make sure that you're okay. Still. Friend of mine that happens. His policy lapsed and he didn't realize, and now he tried to get it back and he's diabetic now. They declined it. Policy, I mean, it was a 30-year term policy. He only had it for a couple more years. So, he's probably not going to die. Policy loans. Policy loan is when there's a cash value. There's a cash value accumulation. You can borrow against it in the form of a loan. So loans are not taxed. That's why they have a loan, because if you took the money, they could potentially tax you on it if it's more than what you paid in, right? So a loan, you're not taxed on a loan. You can imagine if you were taxed on a loan, you get a $300,000 loan for a house, and then boom, they hit you with a crazy tax bill on it. So loans aren't taxed because you got to pay it back. So that's part of the reason why they do loans, because it's not taxable. All right, withdrawal is when you withdraw from the cash value. So you actually withdraw money from it. You're not taking a loan. And then partial surrender is when you're taking a big chunk, like you're partially surrendering that portion of the cash value. You're not taking a loan, you're actually keeping it. That's more common in like universal life stuff. All right. Non-forfeiture options. Non-forfeiture options are in place so that if there's cash value in a policy and the policy is lapsed or surrendered, you're not going to lose it. So it's a guaranteed value that you take from the policy if it lapses or surrendered or canceled or anything. So it's like if you have a house and you're paying your mortgage, you can, if you get rid of your house, then there's still some value there, right? It's the equity essentially. So with the equity, non-forfeiture options are things you can do with the equity. So one non-forfeiture option is called extended term. This is usually the default. So extended term is, say you have a $100,000 whole life policy with $20,000 of cash value, and the policy lapses. That $20,000 of cash value will be used to purchase a $100,000 term policy for however long that policy would be based on your current age. So if you have a 20,000, say there's 20, I'll try to say that in a different way. If there's $20,000 of cash value, you're going to get a term policy for however long. If you went to a life insurance company and you're like, I'm going to give you $20,000, how much term can that buy me? How many years of a $100,000 term can that buy me? And then it just extends out for that time. So it extends the death benefit by using the cash value to buy a term policy. Pretty much like a single premium term policy almost. Does that make sense? Okay. Next one is reduced paid up insurance. So instead of that $20,000 purchasing a term for $100,000, that eventually will expire, that $20,000 will purchase it goes as a single premium whole life. So that $20,000 might buy $35,000 a whole life, or whatever the case is, whatever it is, depending on your age. So extended term matches the face amount of the whole life policy and extends it for however long the cash value buys it for. The reduced paid up insurance buys a permanent policy that's a smaller face amount, but it's permanent. You never have to make another payment. It's never going to expire. Anybody have questions about the difference there? That reduced paid up continues to earn cash value as well in dividends in its own way. Okay, another one is just cash surrender. So you can just get a chunk of money, right? You just get cash. And another one I think is keeping interest, earning interest. So the insurance company can just hold the money and pay you interest on the money that's in the account. There might be another one there, but I think that's the four though. Some companies may let you put it into some sort of a annuity to get paid in payments over time. But you'll see those in the course, and maybe some other ones. Let me ask ChatGPT here. I think I covered most of those though. Cash surrender value, reduced paid up insurance, extended term. Yeah. So the companies want to hang on to the person's money though, obviously, right? Like they want you to keep the money with them because they can keep making interest on it. Dividends and dividend options. So dividends are earned in participating life insurance policy. So you guys know how in a stock company, people who own stock own that company. Okay. In a mutual life insurance company, the policyholders own the company. So in a stock company, the stockholders earn profits. In a mutual company, the policyholders earn profits because they're the ones who own the company. Those profits are distributed in dividends. It's called dividends. It's excess earnings of the company. So when a dividend is declared, it goes towards, there's different things that can be done with dividends. All right. The most common form is purchasing additional insurance, paid up additions. So it purchases very small amounts of paid up whole life insurance that add to the total face amount. So say 1 year your dividend's $100. That $100 goes to purchasing whatever that acts as a single premium for whatever whole life insurance it'll add at that time. So it purchases little pieces of single premium whole life over time, every time a dividend's there. But what it does, it's a snowball effect, because over time, as the face amount grows, the dividends are going to grow too, because there's a bigger policy. Okay. So there's things that you can do with dividends. You can receive the dividends, like I said, you can have it buy more insurance, which is better because it accumulates at a bigger interest rate and stuff. All right. You can have the insurance company hold it and it'll earn interest on it. So the insurance company can hold the dividends and pay you the interest on it, or they can just pay you the dividend. Cash premium. Okay, yeah, cool, perfect. Awesome. So cash, we went that. They receive the dividends in cash. Premium reduction, another thing, they can use the dividends to pay their premiums. Like I said previously, remember? They can use the dividend to just pay their premium if they want. The dividends are left with the insurance company to accumulate interest. It's another one. And the interest earned is typically taxable. Paid up additions. The dividends are used to purchase additional amounts of paid up whole life insurance, which increases the death benefit and cash value. Or 1 year term. The dividends to purchase 1 year term insurance, which provides additional death benefit for a specified period. Most common one is paid up additions. That's how people get like really big whole life policies that accumulate a lot of cash value. The policies we sell are not participating. Participating policies typically cost more money. They're usually more expensive than a stock policy from a non-participating company that doesn't receive dividends. Okay. We're looking to get our clients the cheapest death benefit for the money. Like a lot of them are older and they have health issues, and that ship of earning cash value has sailed like years ago. Okay. Incontestability. So incontestability means that after a life insurance policy has been enforced for 2 years, the insurance company can't contest the claim, so they got to pay it. So if like suicide's a big one, that's why they put contestability period in there. Because I mean, obviously, if someone's going to commit suicide, why not get a life insurance policy, right? People usually do it because they feel inadequate or something, So they're like, well, I'm going to leave at least I'll be worth it to my family now, and then leave them with money or something like that. So incontestability is they can contest the claim within 2 years. So another one too, like I had a client we had an agent who's bought a life insurance policy on her dad, and he died in a fire. Unfortunately, it's like really sad. But she was upset because she's like, man, they want the police report and everything. And I said, yeah, but think about it from an insurance company's perspective. Like fire, they're not trying to not pay the claim. They're just trying to make sure that a fire, it's nothing fraudulent, because fire is like, the number one thing for fraud for insurance. Oh, what happened to the restaurant? I don't know. It burnt down. I need my insurance claim. No idea what happened. It's all ashes. It all disappeared, right? So they needed to police report, fire report, and everything else, and autopsy, coroner's report, or whatever. Doctors, they needed all that to show, okay, yeah, he did die in a fire. That was in the first 2 years, though. If it was outside the first 2 years, they wouldn't have contested the claim. Assignments. I think assignments is ownership. To be honest, I'm not sure exactly what that means, or beneficiary assignments. I'm not 100% sure what that means by assignment right there, guys. Suicide, typically it's 1 year in some states, but 2 years in most states. If the insured commits suicide within that time frame, then the claim is not paid. But after that time frame, the claim is paid if the insured commits suicide. It's just like a cool down period. It's like if someone purchases a firearm, there's a cool down period of, well, we're not going to say the pistol today, but you come back in a week, that way they're still pissed, then, that's on them. Misstatement of age and gender. So misstatement of age and gender. Remember how I told you I had that lady who thought she was 72, she's 73 or whatever? So it happens more than you think. So if she applied thinking she's a certain age and then she dies, but she's actually younger, then the insurance company is going to pay more death benefit, right? Does that make sense? They're going to pay more money because she was actually younger when she got the policy. So they underestimated the face amount. But if she's older, they're going to pay less. That's if she dies. If they find out while she's alive, I'm pretty sure they adjust either the death benefit or the premium. Usually they'll increase the premium, and then she could always lower the face amount. But if they find out while she's alive, they would just increase the premium and say, oh, we issued you too much insurance for how much you're paying. You're going to have to pay more, but she can just reduce the face amount of it if she needed to. Gender as well. So if someone is, they go by gender at birth, obviously. So if someone was born a male and says that they're now a guy, I mean, a woman, they can apply as a woman. The insurance company may not approve them, but if they get approved as a woman and they die, then they're just gonna pay the claim out gender at birth, right? Because typically men have lower life expectancy than women. Although I don't know if that changed now, right? Now that women are like usually having the same jobs as men, so I don't know if maybe it's I don't know, but obviously that's very important, right? On an application for life insurance, gender. So yeah, that's how that works. Settlement options is if for the death benefit. So the most common one is just a chunk of money, right? Like you get money when the insured dies, the beneficiary gets a chunk of cash. But there's other things that can be done too. One of them, the money can just sit there and collect interest. So they get the death benefit, the insured dies, the insurance company keeps the death benefit in their account, and they just pay interest to the beneficiary. The interest is taxed, the benefit is not. Okay. So the interest is taxed, the benefit's not. Another one is maybe they want it to turn into an annuity. So they just want income payments. Same thing like if someone wins the lottery, guys, right? You know how you can choose a lump sum or get paid in installments? You can do the same thing with life insurance. If you choose to get paid in installments, you usually end up getting more money over time because the money sits in the insurance company's account, builds interest, and then you make some of that interest too. All right. So there's different ways that can be structured. It can be, okay, we're going to pay you a certain amount of money until there's no more benefit left, or we're going to pay you a certain amount for a certain amount of we're going to pay you for a certain amount of time, like even installments, or we're just going to pay you for life, and if you outlive it, then you make more, you make out. If you die prematurely, then we make out. So it's essentially when a death benefit becomes an annuity. And then there's accelerated death benefits, which is if the client is ever terminally ill, then they'll be advanced the full face amount of the policy, or up to a certain percent. Some companies do the full face amount. I think in the course it says 50%. A lot of companies do 50%, but some companies that we work with do 100% of the face amount will be advanced if the client's terminally ill. Some states, terminally ill means the doctor says you have less than a year to live. Some states, it means the doctor says you have less than 2 years to live, depending on the state. But it's essentially the doctor says you're going to pass away at some point in the near future. So the company gives them the money ahead of time. That way they don't have to sell their life insurance policy, because people used to sell the policy, right? Called a viatical settlement. So imagine like I have $1 million policy and I'm going to die in 6 months, but there's a treatment that's like $100,000 that could save my life. I mean, shoot, I'm going to sell my policy for 600,000, even though I could get my family's going to get $1 million. I'll sell that policy for 600,000 or 700,000, spend 100,000 on the treatment, and see if it works for me to live. So the reason why life insurance companies do this with accelerated benefits is so that people don't have to sell the policy for someone else to profit off their death, because they don't really like that. Okay. Policy exclusion. So war. So a lot of policies will say if you die in an act of war, they're not going to pay it. All right. Aviation typically says like if you're a pilot, like a not a commercial pilot, but if you die in an accident on an airplane and it's not commercial aviation, so if you fly like private or you fly your own plane or something and you die, then they're not going to cover it typically. There can be clauses and there can be exclusions. It has to be included though. The exclusion has to be included in the policy for them to exercise that. And another one is dangerous occupation. So dangerous occupation is a dangerous occupation. I mean, it is what it is. It is what it says. If you're like an underwater welder, in the Bering Sea, I'm sure that's, you know, they're gonna be like, they're gonna take that into account. As opposed to if you sell life insurance from home in a comfy chair. Any questions, anybody so far? Okay, cool. So what I'm gonna do here is